Don't believe what you're seeing in the headlines. The financial media is treating the escalating confrontation between Trump and the Federal Reserve as political theater, another episode of presidential grandstanding that will fade into irrelevance once the news cycle moves on. They're wrong. What's playing out right now isn't theater. It's the opening phase of a constitutional crisis that will determine whether the United States maintains central bank independence, whether the dollar retains reserve currency status, and whether American borrowing costs remain sustainable. And there's a specific deadline driving this confrontation, December 2026, when approximately $8 trillion in Treasury securities mature and need to be rolled over at rates that could reach 5% if the Fed maintains its current policy trajectory. Here's what nobody is discussing in mainstream coverage. Trump isn't attacking the Federal Reserve because he's impulsive or because he wants lower rates for political purposes. He's attacking the Federal Reserve because the current interest rate path makes it mathematically impossible for the federal government to service its debt without either catastrophic spending cuts, massive tax increases, or monetization that triggers hyperinflation. The federal government currently pays approximately $892 billion annually in interest on $2 trillion of debt at an average interest rate of 46%. If that average rate increases to 5%, which is where it's headed if the Fed follows its stated policy path, annual interest payments increase to $3.07 trillion. That's more than the entire defense budget, Medicare, and Social Security combined. It's not sustainable, it's not payable, and Trump knows it. I've spent over a decade analyzing sovereign debt crises and central bank policy conflicts. I've studied every major confrontation between political leaders and central banks from Argentina to Zimbabwe. And I can tell you with absolute certainty, what Trump is attempting is either the most sophisticated financial power play in modern American history or the beginning of a debt crisis that will make 2008 look minor by comparison. The outcome depends entirely on who blinks first, the Fed or the Treasury. And the deadline for that confrontation is December 2026, which is why the rhetoric is escalating now rather than later. Chapter 1, the debt maturity wall that's coming. Let's start with the specific numbers that drive this entire confrontation, because the debt maturity schedule matters enormously, and most people have no concept of how much debt the federal government needs to refinance over the next 18 months. According to data from the U.S. Treasury's Bureau of Fiscal Service, the federal government has $8 trillion in Treasury securities maturing between now and December 2026. That doesn't include new borrowing to fund deficit spending, which adds approximately another $4 trillion over the same period based on Congressional Budget Office projections. So, the total amount that needs to be borrowed between now and December 2026 is approximately $2 trillion. When those securities were originally issued, most of them carried interest rates between 25 and 5%, reflecting the ultra-low rate environment that prevailed between 2008 and 2021. The weighted average interest rate on currently maturing securities is approximately 87%. But the securities that will replace them need to be sold at current market rates, which as of April 2026 range from 2% for short-term Treasury bills to 8% for 10-year Treasury notes. Here's the math that should terrify anyone who understands government finance. The $8 trillion in maturing debt currently costs approximately $127 billion annually in interest payments. If that debt is refinanced at an average rate of 5%, the annual interest cost increases to $374 billion. That's an additional $247 billion per year in interest payments just from refinancing existing debt, not from new borrowing. Now add the $4 trillion in new borrowing to fund deficits at 5% interest rates. That adds another $132 billion in annual interest costs. So, over 18 months, the federal government's annual interest payments increase by approximately $379 billion, just from the combination of debt refinancing and new borrowing. That increases total annual interest costs from $892 billion currently to approximately $27 trillion by December 2026. But wait, it gets worse. The Federal Reserve has stated that it intends to continue raising rates until inflation is durably at 2%. Core inflation is currently running at 8% according to the latest CPI data. If the Fed follows through on its commitment, rates will likely need to reach 5 to 5% to bring inflation down to target. And some Fed governors have stated publicly that rates might need to reach 8 to 9% if inflation proves more persistent than currently anticipated. Let's run the numbers at an 5% average interest rate, which is the high end of current Fed projections. The $8 trillion in maturing debt would cost approximately $578 billion annually to service. The $4 trillion in new borrowing would cost approximately $204 billion annually. Total interest costs would be approximately $67 trillion per year, which is nearly double the current level. That's not a sustainable trajectory. Federal revenue is approximately $9 trillion annually, according to the latest Treasury data. If $67 trillion of that revenue goes to interest payments, that leaves $23 trillion for all other government functions. But mandatory spending, including Social Security, Medicare, and Medicaid, totals approximately $1 trillion. That leaves only $130 billion for defense, infrastructure, education, law enforcement, foreign aid, and every other discretionary program. The entire defense budget alone is $842 billion, which means something has to give catastrophically. Chapter 2, Trump's 3 options and why none of them work. Trump understands these numbers. His Treasury advisors have certainly walked him through the debt maturity wall and the interest cost implications. So he has 3 theoretical options for avoiding the crisis, and all 3 are politically or economically catastrophic. Option 1, spending cuts. The government could reduce spending to free up budget space for higher interest payments. To accommodate $67 trillion in annual interest costs while maintaining current revenue levels, the government would need to cut approximately $780 billion from annual spending. That's roughly equivalent to eliminating the entire defense budget or cutting Social Security and Medicare by approximately 25%. Neither option is politically viable. Republicans won't accept defense cuts of that magnitude, and cutting Social Security or Medicare by 25% would trigger electoral annihilation for any party that attempted it. According to AARP polling data from March 2026, approximately 87% of Americans oppose any cuts to Social Security or Medicare, regardless of budget constraints. The political coalition necessary to implement spending cuts at this scale does not exist and will not exist. Option 2, tax increases. The government could raise taxes to increase revenue and cover higher interest costs. To generate an additional $780 billion in annual revenue would require tax increases of approximately 16% across all brackets, or alternatively, massive increases on high earners and corporations that would generate equivalent revenue. But tax increases face the same political obstacles as spending cuts. Republicans control enough political power to block major tax increases, and even Democrats are hesitant to propose tax increases that would affect middle-class voters. According to Congressional Budget Office analysis, raising the revenue necessary to cover projected interest cost increases would require either increasing the top marginal income tax rate from 37% to approximately 52%, or implementing a value-added tax, similar to European models that would add 15 to 20% to consumer prices. Neither approach is politically viable. High-income earners are the primary source of campaign donations for both parties, and any politician who proposes a 52% top marginal rate faces funding difficulties and primary challenges from opponents who promise tax cuts instead. A value-added tax would be economically regressive, hitting low-income households hardest, and would face opposition from both progressive Democrats who oppose regressive taxation and Republicans who oppose any new taxes. Option 3, Federal Reserve monetization. The third option is to pressure or force the Federal Reserve to buy Treasury securities at whatever quantity is necessary to keep interest rates low, regardless of inflation consequences. This is what Trump is attempting through his public attacks on the Fed and through behind-the-scenes pressure on Fed governors whose terms are expiring and who need presidential reappointment. The mechanism would work like this. The Treasury issues $2 trillion in securities between now and December 2026. The market is unwilling to buy all those securities at rates below 5%, because that's what's required to compensate investors for inflation risk and credit risk. So, the Federal Reserve steps in and buys whatever portion of the issuance that private markets won't absorb at lower rates. The Fed's balance sheet expands, money supply increases, and interest rates are held down artificially through central bank intervention. This is monetary financing of government deficits, and it's exactly what happened during World War II, what happened in Latin American debt crises, and what's currently happening in Japan. The consequences are entirely predictable. Inflation accelerates because money supply is growing faster than economic output. The currency depreciates because international investors recognize that the central bank is monetizing deficits rather than maintaining price stability. And eventually, you get either hyperinflation if the monetization continues, or you get a debt crisis when the monetization stops and interest rates spike to compensate for accumulated inflation risk. Trump understands these trade-offs, or at least his advisors do. But from his perspective, the consequences of monetization play out over years or decades, while the consequences of the debt maturity wall hit in December 2026. If you're optimizing for short-term political survival rather than long-term economic stability, monetization is the least bad option because it defers the crisis rather than triggering it immediately. Chapter 3, the constitutional crisis that's coming. Here's where this confrontation becomes a genuine constitutional crisis rather than just another policy dispute. The Federal Reserve is technically an independent agency created by Congress, but not controlled by the President or by Congress directly. The Fed's independence is not constitutionally mandated. It's a statutory arrangement that Congress could change at any time with appropriate legislation. Trump is arguing both publicly and through proxies that Fed independence is not sustainable when Fed policy makes it impossible for the elected government to function. His position is that the Fed has a responsibility to facilitate government financing at rates that allow the government to pay its bills, and that prioritizing inflation control over fiscal sustainability represents the Fed prioritizing technocratic preferences over democratic accountability. There's actually a legitimate constitutional argument buried in Trump's position, even if his motivations are purely political. The Constitution grants Congress the power to borrow money on the credit of the United States. If Federal Reserve policy makes it prohibitively expensive or impossible for Congress to exercise that constitutional power, then arguably the Fed is frustrating constitutional functions. That's not how constitutional law has been interpreted historically, but it's not a frivolous argument either. The Fed's counter-argument is that its mandate from Congress is to maintain price stability and maximum employment, and that maintaining those mandates requires interest rates that are determined by economic conditions rather than by political preferences. The Fed argues that if it subordinates monetary policy to fiscal policy, it loses credibility with markets, inflation expectations become unanchored, and the dollar loses reserve currency status because international investors lose confidence in American monetary stability. Both arguments have merit, which is what makes this a genuine crisis rather than a simple power grab. The government legitimately cannot function sustainably, with interest costs consuming 34% of revenue. But the Fed legitimately cannot maintain price stability if it's forced to monetize deficits, regardless of inflation consequences. These are incompatible imperatives, and American political and economic institutions don't have an established mechanism for resolving the conflict. What we're heading toward is a test of whether political power or institutional independence prevails when they come into direct conflict. If Trump successfully pressures the Fed into monetizing deficits, Fed independence ends functionally, even if it continues formally. Central banks that monetize deficits at political direction lose credibility immediately, and once credibility is lost, it cannot be recovered without decades of demonstrated independence. Alternatively, if the Fed refuses to accommodate fiscal needs, the government faces either default on obligations, catastrophic spending cuts, or massive tax increases. Any of those outcomes would trigger economic crisis and political upheaval. So both sides face catastrophic consequences if the other side prevails, which means neither side can afford to back down. Chapter 4, the international implications. Nobody's calculating, but the Trump-Fed confrontation isn't just a domestic American crisis. It has immediate and profound implications for global financial stability and for the dollar's role as the world's reserve currency. And the international dimension is what makes this confrontation so dangerous, because most American policymakers are focused on domestic political considerations without fully processing how international markets will react. The dollar is the world's reserve currency because international investors trust that the United States will maintain stable monetary policy, that the Federal Reserve will prioritize price stability over political convenience, and that dollar-denominated assets will retain value over time. That trust is based on institutional credibility that took decades to establish after the Bretton Woods collapse and the inflation of the 1970s. If Trump successfully subordinates the Fed to political control and forces monetization of deficits, that institutional credibility evaporates immediately. International investors would recognize that the United States is no longer committed to price stability, that monetary policy will be determined by political expedience rather than by economic conditions, and that dollar-denominated assets face uncontrolled inflation risk. The immediate consequence would be capital flight from dollar assets. According to data from the Treasury Department, foreign investors hold approximately $2 trillion in U.S. Treasury securities, which represents approximately 23% of all outstanding Treasury debt. If even 20% of those foreign investors decide to exit dollar assets due to concerns about Fed independence, that represents $64 trillion in selling pressure. Treasury markets cannot absorb that kind of selling pressure without catastrophic price declines. Our $64 trillion sell-off would drive Treasury prices down approximately 15 to 20%, according to estimates from J.P. Morgan's Fixed Income Research Team. That price decline translates directly to interest rate increases. If 10-year Treasury yields are currently 8%, a 15% price decline would push yields to approximately 2%. That makes the debt maturity problem substantially worse rather than better, because now the government needs to refinance at even higher rates. But the capital flight wouldn't stop with treasuries. International investors hold approximately $7 trillion in U.S. stocks, $3 trillion in corporate bonds, $8 trillion in real estate, and $1 trillion in other dollar-denominated assets, according to Bureau of Economic Analysis data. If those investors lose confidence in dollar stability, they'll liquidate other dollar assets as well. A broad-based flight from dollar assets would crash American stock markets, real estate markets, and bond markets simultaneously. Think about what that means. The United States currently maintains its standard of living partly through international capital inflows that fund consumption beyond what American production generates. We run a current account deficit of approximately $890 billion annually, which means we consume $890 billion more than we produce. That deficit is funded by foreigners who buy dollar assets. If foreigners stop buying dollar assets or start selling existing holdings, the current account deficit becomes unfundable. The United States would be forced to reduce consumption to match production, which means a $890 billion reduction in American living standards. That's approximately $2,600 per capita in reduced consumption. Your wages don't change, but the goods and services available to purchase with those wages decline because imports become prohibitively expensive when foreigners stop accepting dollars in payment. This is what happens when reserve currency status is lost. The standard of living that was sustained by international willingness to hold your currency collapses when that willingness evaporates. Chapter 5. Why 8? 5% is the breaking point. Let me walk you through why 8. 5% is the specific threshold that triggers systemic collapse rather than just fiscal stress. The number isn't arbitrary. It's the point at which interest costs exceed the government's ability to pay without either defaulting, slashing spending catastrophically, or resorting to monetary financing that triggers hyperinflation. At 5% average interest rates, the government pays approximately $3.07 trillion annually in interest on 36, $2 trillion in debt. Federal revenue is projected to be approximately $1 trillion in fiscal year 2027, according to Congressional Budget Office estimates. That means 60% of revenue goes to interest payments alone, leaving only $2.03 trillion for all other government functions. But mandatory spending, including Social Security, Medicare, and Medicaid, is constitutionally and statutorily required. Those programs cost approximately $1 trillion annually and are projected to grow to $3 trillion by 2027. So mandatory spending exceeds available revenue after interest payments by approximately $27 trillion. That gap has to be filled somehow. The government could theoretically eliminate all discretionary spending, including defense, infrastructure, education, law enforcement, foreign aid, and every other non-mandatory program. That would save approximately $8 trillion and would cover the $27 trillion gap, with about $530 billion left over for minimal government operations. But eliminating the entire defense budget, all federal law enforcement, all infrastructure spending, and all federal support for education would trigger social and political collapse. It's not a viable option, even in theory. So at 5% rates, the government mathematically cannot meet its obligations without either defaulting, cutting mandatory programs that are politically untouchable, raising taxes to levels that would crater the economy, or forcing the Fed to monetize deficits. There's no fifth option. The arithmetic doesn't allow one. This is why 5% is the breaking point. Below that threshold, the fiscal situation is painful but manageable through some combination of spending constraints and revenue increases. Above that threshold, the situation becomes mathematically unsustainable regardless of what political choices are made. And current Fed policy trajectory heads directly toward that breaking point, which is why Trump is escalating the confrontation now rather than waiting for the crisis to materialize. Chapter 6. The historical parallels that show how this ends. This isn't the first time a government has faced the choice between central bank independence and fiscal sustainability. The historical record is unambiguous about how these confrontations resolve, and the pattern should alarm anyone who understands the mechanics of sovereign debt crises. The classic case is Argentina between 2001 and 2002. The Argentine government was running large deficits and had accumulated debt that was becoming difficult to service. The Argentine central bank maintained a currency peg to the dollar and operated independently from political control. The government pressured the central bank to abandon the peg and monetize deficits to make debt servicing easier. The central bank initially refused. Eventually, political pressure became overwhelming, the central bank capitulated, the currency peg was abandoned, and Argentina experienced hyperinflation followed by debt default. The Argentine peso lost approximately 75% of its value against the dollar within 6 months. Inflation reached approximately 40% annually. The government defaulted on $82 billion in debt, the largest sovereign default in history at that time. The economy contracted by approximately 11% in 2002. Unemployment reached 25%. And it took Argentina approximately 15 years to regain access to international capital markets on reasonable terms. The mechanism is always the same. The government faces unsustainable debt costs. The central bank maintains policies that prioritize price stability over fiscal sustainability. The government pressures the central bank to accommodate fiscal needs. Eventually, the central bank either capitulates and loses credibility or refuses, and the government faces crisis. If the central bank capitulates, you get inflation and currency collapse. If the central bank refuses, you get default and economic depression. There's no scenario where everyone wins. Japan presents a different case study with potentially more relevance to the American situation. Japan has been running large fiscal deficits for 30 years and has accumulated debt exceeding 260% of GDP, by far the highest in the developed world. The Bank of Japan has monetized most of that debt through quantitative easing programs that keep interest rates near zero. Japan has avoided hyperinflation because Japanese citizens have high savings rates and are willing to hold government debt at very low yields. But Japan has also experienced 3 decades of near-zero economic growth, declining population, and steadily eroding living standards for working-age citizens. The Bank of Japan is trapped. It cannot raise interest rates without triggering a debt crisis because the government cannot afford to pay higher rates on debt exceeding 260% of GDP. But it cannot maintain zero rates indefinitely without eventually triggering inflation as population aging reduces savings rates and forces the government to run even larger deficits. The U.S. could potentially follow the Japanese path, maintain artificially low rates through Fed monetization, accept near-zero growth and gradually declining living standards, and hope that something changes before the system breaks. But the U.S. faces constraints that Japan doesn't. American savings rates are much lower, so there's less domestic demand for government debt at low yields. The dollar is a reserve currency, so monetary financing would trigger international capital flight that Japan doesn't face because the yen is not a reserve currency. And American political culture won't accept decades of stagnation the way Japanese culture has, which means political instability would accelerate faster in the U.S. than it has in Japan. Chapter 7. What Trump is actually gambling on. Here's what I think Trump is actually calculating, based on analyzing his public statements and his advisors' positions.